Softer end to 2025, housing market momentum fades into 2026. That's what the numbers are telling us. House prices didn't crash at the end of 2025. They didn't shoot up either. They slowed. Quietly. Almost politely. There were no big headlines. No drama. No one running about in a flap. Just a set of numbers dropped in early January. That didn't behave the way most folks were expecting. December is usually when the UK housing market is ticking over. By then, interest rate shocks have already filtered through. Buyers and sellers have adjusted. Lenders have sorted their risk models. Whatever weakness exists is usually spotted a bit earlier in the year. But this time, the slowdown turned up late. And that timing gave economists a bit of a heads up. Because when a market loses pace, after it's had time to adapt, it's rarely about a single month. It's about confidence quietly pulling back. Under the surface, the signal came from one of the UK's most closely watched indicators. Data released by Nationwide. In November 2025, annual house price growth stood at 1.8%. That figure already suggested modest conditions. But it sort of lined up with expectations of stabilization. By December, that growth rate had slowed sharply to 0.6%. Month on month, prices dipped. On paper, prices were still up on the year. Technically, the market was still all right. But housing markets don't move on technicalities. They move on direction and belief. A slowdown like this, turning up at year-end, shook the idea that the market had found a stable floor. It wasn't panic. It was hesitation. And hesitation spreads quietly. Estate agents notice fewer follow-up calls. Viewings still happen. But offers are pulling back. Listings linger a bit longer. Nothing breaks. But nothing really moves either. A falling housing market grabs attention. A stalling one you can easily ignore. But history shows that dragging along quietly often does more damage than a sharp tumble. When prices drop decisively, behavior shifts quickly. Sellers adjust their expectations. Buyers step in, spotting a bargain. Activity picks up again, even if prices are a bit lower. When prices stall, the opposite happens. Buyers wait for clarity. Sellers hang tight for better conditions. Builders slow the pace. Banks get a bit choosy, even without tightening rules. The system slows from the inside. This matters because housing is tied to the wider economy. Fewer sales mean fewer removals, fewer renovations, fewer solicitors and surveyors needed, less spending in local shops and businesses. It doesn't seem dramatic on its own, but together, it starts to drag things down. And drag, over time, builds pressure. Normal mortgage approvals, abnormal reality. Throughout late 2025, a familiar reassurance popped up a lot. Mortgage approvals were said to be near pre-pandemic levels. That sounds comforting, stable, familiar. But it's a bit misleading. Pre-pandemic approvals happened in a very different market. Prices were lower compared to wages. Deposits were smaller. Monthly repayments weren't so heavy. In 2026, even buyers who get mortgage approval often find themselves stretching further than they'd like. So approvals don't always turn into completed sales. People hesitate, renegotiate, sometimes walk away. On paper, lending carries on. In reality, confidence doesn't. This gap is subtle, but it's powerful. It delays stress signals until they are already hanging around. December data had a little nugget that slipped past most headlines. East Anglia was the only UK region to record an annual price drop. One region doesn't spell disaster. But housing slowdowns rarely hit everywhere at once. They start where affordability is tightest, compared to local wages, where demand is discretionary, where confidence matters more than necessity. East Anglia includes commuter zones and semi-rural areas that benefited during ultra-low interest rates. Those same markets are more sensitive when borrowing costs rise and job certainty softens. When buyers pull back their first, it's rarely random. It's the system quietly signaling restraint. For years, the UK housing market was driven by one strong belief: waiting would make things worse. Prices kept rising. Rents kept climbing. Borrowing felt urgent. That belief pushed people to stretch a bit further. Now, that belief is wearing thin. If prices aren't rising, and might drift, urgency fades. First-time buyers pause. Second-steppers hang back. Investors crunch the numbers again. This is demand exhaustion. Not because people don't want homes, but because fewer people can justify paying more under tighter conditions. Demand doesn't vanish overnight. It just thins out. And thinning demand quietly changes everything. All of this is unfolding against a steady policy backdrop. The Bank of England has made clear that while rates aren't rising aggressively, monetary policy remains tight. Housing is one of the main ways that restraint works. Through the economy, higher borrowing costs, cooler demand, slows price growth, slower growth, hits confidence. It's not an accident. It's how modern monetary policy functions. But it works gradually, and gradual pressure is harder to spot until behavior has already shifted.